From Morningstar, I'm Jeremy Glazer. As expected, the Fed raised its benchmark rate by 25 basis points today. I'm here with Bob Johnson. He's our Director of Economic Analysis to see if we learned anything new from this release. Bob, thanks for joining me.
Great to be here today.
So the Fed really almost went out of its way to get the market ready for this increase today. There really was no big surprise, at least on that front.
Absolutely not. I mean, it was they had sent out a bunch of people, Fed governors, to go out and make speeches, and they've all indicated they thought rates would probably move higher. And we went from 3 weeks ago with a zero probability of a rate hike to almost 100% 3 weeks later, and sure, lo and behold, we got the number.
But beyond the rate hike, we're also looking at what they say in the statement, the so-called dot plot, their economic projections. When you look at everything else that happened, any surprises there, or is it still just business as usual?
You know, it's really business as usual. And the economic forecast, which we always take a close look at, was unchanged, as was the unemployment rate, as was their inflation assumption. So there was no change from their December meeting. They're thinking relatively low GDP growth of about 1.9%, about 2% inflation, both core and headline equaling each other here in the very near future. So it was a very boring kind of steady state, no recession in sight, no growth spurt in sight type of forecast.
So they don't see anything fundamentally changing in the economy. They just think it's time for rates to move higher?
I think that what they stressed is they wanted to give themselves some wiggle room if some external shock hit the economy, that they've got some room to adjust, which when you have rates terribly low, you really don't have much room to operate in. And that's part of what's going on. And I certainly think that part of the inflation data, you know, you want to be a little cautious. We can talk about the inflation data, but it has moved up, and it certainly had some impact on the consumer already.
I want to look at that dot plot a little bit more closely. It shows where governors think rates will be, both in the short term and the longer term. And it looks like they're kind of ready for a stair-step up to get to that 3% longer-term rate. Is that realistic? Can we see 2 more increases this year?
You know what? I think either we'll have some type of spurt or stimulus, or something happen with oil prices that will force their hand and make them work faster, or that we'll have a slowdown, which will make them move slower. And then maybe start again. But in any case, I think that we won't get the stair-step that they're predicting. I mean, they're basically saying every 3 or 4 months we're going to raise rates from now until the end of 2018, until we get to about a 3% Fed funds rate from the 3/4 to 1% that they moved the rate to today.
What's next for the Fed then? What do you think they'll be looking at closely? Does the labor market hold up? Is it inflation? Is it a combination of things? What will predict if they actually are able to continue on this steady move? Well,
they really stress that they're still very data dependent, you know, and everybody tried to focus them on the dot plot and the nice stair step and the move up, 2 more rate moves this year. But really, it's all dependent on the data. They continue to stress that, well, if the economy slowed or if it's not as strong or as weak as people think, then we'll have to act differently, that this is not cast in stone. This is just kind of our roadmap. And if we start to vary a little bit on inflation or growth rates, well, then we'll have to reconsider what we do with our interest rates.
Overall, do you think the Fed is making the right moves here? Does their take on the economy kind of agree with yours, Bob?
Well, I think that they made the right move right now. I think they had to give themselves some more wiggle room in case we did hit unexpected turbulence and they needed to stimulate the economy. They really didn't have much room to do that from where they are right now. So that gave them that extra room, and that's why I think they needed to do it. And I think they also inflation was starting to look a little higher, so I think they wanted to make sure that things didn't get out of hand there a little bit. So I think it was great from that standpoint. The market had already kind of priced it into their expectations. So why not do it? And certainly if something turned into a problem, they could always roll it back at another meeting. So I think that it was the right move. Longer term, I think that perhaps they are a little bit too optimistic on the economy. I think that certainly the data we've seen recently looks a little weak with the consumer, which is 70% of the economy being affected by higher inflation. And not that much higher inflation, but higher inflation. At the same time, wage growth is about the same as it's been for the last 2 years. So that clearly puts the consumer in a little bit of a bind.
Bob, thanks for your analysis today.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.